there's nothing wrong with traditional full doc loans. But when compared to DSCR loans, there's only really one reason you would still choose it. Listen to this episode to figure out what that one reason is.
Howdy.
Adam Messmer at the Loan Lounge.
That's
How are
me.
you?
I'm great. How are you, Liz Lawrence?
Just dandy.
Good.
Every day, got another third cup of coffee. I'm
Third
ready.
cup
Let's
of coffee.
Go. Let's go.
You're jacked.
Let's talk about loans.
All jacked up on Mountain Dew. What are we talking about today? We're talking about the difference between in the lending experience between conventional lending versus DSCR lending.
Yeah, I would say it's easier.
Yeah.
Oh, wait, that's probably not enough detail. We can't just end the podcast just like that.
There it is.
I mean, sorry, that's
Roll
all we
credits.
got. Sorry.
Yeah.
No, I mean, there's a lot. So especially for our newer investors who still have their W-2s and can still personally qualify, I get it. You should definitely exhaust that option because though we are not NMLS licensed, we don't do conventional financing, et cetera. We both came from conventional backgrounds, so we know enough to be dangerous. So know that we are not giving licensed advice, but we, again, go Google it. It's the same information.
Yeah.
So in the conventional world, you can have up to 10 finance properties, including your primary residence. So you could have 9 investment properties in theory. I think what tends to happen is maybe a mix of things. One, an investor, buys their first deal. Sure, go conventional. I went conventional way back when. But then they grow and their DTI gets thinner, or maybe they quit their W-2 to kind of focus on this full time. And those options are no longer viable. On top of that, we have a layer of benefits for going DSCR. Let's start with the fact that you can close in an LLC. So on the conventional side, you cannot. They're going to have you close in your personal name. Now, do people quit claim afterwards into LLCs? Sure. Is there someone from Fannie and Freddie knocking on your door saying, why did you do that? No, but the note probably has some verbiage in there that technically they could probably call the note due if you haven't notified them that you're making this change. So if you're the, buy the book person, if you want this to close in an LLC, you're coming DSCR no matter which way we cut it. What's another benefit?
Of going DSCR versus conventional, I mean, so you can close an LLC. It often does not report to your personal credit, although I put a little asterisk there because at the end of the day, what I've learned is that it tends to be up to the servicer,
correct,
as to whether or not it reports to your personal credit. So you've got a couple people that are involved in the transaction, right? There's the lender, and they are going to provide the funding for the transaction. There's the broker, that's us, and so we're the go-between, and we help vet the deal and
make sure you're in the right spot.
Make sure you're in the right spot. And then there's the servicer, and that's who you pay your monthly payment to.
Yep.
And if you go to your local bank, chances are the lender and the servicer are the same person. But when it comes to DSCR lending, almost inevitably, I mean, I think every single one.
100%.
Yeah.
Yep.
The lender and the servicer are not the same person.
Yeah, I would say unless you're going fix and flip loans, sometimes those are direct to the lender.
Yeah. What else we got?
So if it doesn't report to personal credit, is that helpful? I think some direct lenders put a lot more weight on this not reporting to personal credit in the sense of it won't affect your DTI at all. That's not true. In the conventional financing space, when we were, little baby loan officers, there are certain loan approvals where tax returns were not required. And the approval came through, you didn't need to get into those weeds, and you moved on and you closed your deal. It's based on a desktop underwriting system, a computer that says, I need these documents to approve the loan. If that report comes out and it says tax returns, this business is going to be on your tax returns. If there is a gain or a loss in your rental portfolio, those gains and losses will have to be documented, and that could affect your approval. Now, do I think that it is a cheaper deduction than having the full monthly payment, having to document the lease agreement, having to document the mortgage statement, all of the shenanigans that comes with conventional? 100%. And does it likely affect your DTI less? Sure. But this concept of it doesn't affect it at all, I think is a not so accurate fact. So facts from Liz. What is next? So we are closing an LLC. We are not reporting to personal credit. What about credit?
Oh, yeah. So here's a key feature. If you are in a DSCR loan or going for a DSCR loan and you've got two partners and one has really good credit but one has really bad credit, In the conventional world, they have to go off the lower of the two credit scores. But in the DSCR world, we go off the higher of the two credit scores.
Talk dirty.
So that's huge.
Oh my gosh, I think it's massive.
Yeah.
Like, I think that relationship dynamic is very standard operating procedure, that someone has great credit, someone has mediocre credit. And I mean, that would change your interest rate, that would change your leverage. In the conventional space, that might change your overall approval altogether, where that's not really going to play a factor at all in our space. So
And
that's
I mean,
huge.
think about this, new people. When you're brand new at real estate investing and you're trying to figure out what can you bring to the table with seasoned, experienced investors, and that is that some of these seasoned, experienced investors don't manage their credit very well, right?
They just have too much in the pot.
They just have too much in the pot because maybe their credit utilization is too high, or they're just
Credit pulls.
They're getting a ton of credit pulls, something like that. So something that you can do is you can be the guarantor on the loan by having good credit. So if you come to the table with really good credit, and maybe the other guy has really good experience and has done a lot of flips or owns a lot of rentals, then that's a great marriage because you can really leverage both sides of it, and the lender will often look at both sides of the same coin in the most positive light.
Yeah, they'll look at the experience of one and the credit of another, which gets you the best terms out there.
Yeah.
I would say the biggest, in my opinion, difference between conventional and DSCR is down payment.
Oh, yeah.
And I don't think this is known very much out there. So on a single family cookie cutter, they're about the same. They're pretty much the same terms and conditions. What does change is if you get into the 2 to 4 family space. If you get into the 2 to 4 family space, your max loan to value, meaning overall what your down payment on a conventional loan is 25% down. If you come over here to our side of things, we can get that down payment down to 5% on a multifamily deal. I mean, here in Columbus, you couldn't buy a multifamily for much less than like 300,000.
Yeah.
That's 15 grand.
That's a lot.
That's not nothing.
Yeah.
And especially if the property still cash flows super strong, you would hate to have to toss 15 grand into a deal unnecessarily. And then on the cash out refi side, 70. So you're leaving that 5% in the deal unnecessarily, where we can get you that 15 grand cash out and continue growing your portfolio. So I think that's just huge. Okay, conventional, we'll give you the time. Here you go. Here's your moment. Why would you go conventional?
Why would you go conventional? Let's say you've got amazing income and you've got a very low DTI, and it's maybe your first property, and maybe you only want to buy one property. Maybe it's just a one and done thing. You're buying something that is going to be primarily investment, or maybe a second home that might have an investment aspect to it.
Yeah.
That might be a good reason to go conventional. If you don't want to expand, if you're just doing the one thing, I think
makes sense.
That's a good reason. But I mean, I think, people are like, well, why? So, okay, let me ask this. What's the downside to DSCR? And I think the downside is that it's more expensive, right?
Yes. Yeah,
That's
I would say pricing overall, is it dramatically different?
Not really.
I really think it's not as different as you think it is. And
Yeah.
especially the tolerance for investment properties in the conventional space is much different. And I would say right after COVID, conventional lenders did not want anything to do with investment loans. I think that's softened up a little bit as we've moved out of COVID. And so at one point, our pricing was almost identical.
Yeah.
And that was
They
just
were almost
incredible.
at parity. Yeah.
I will say there's probably if you had to guess, maybe a 0.25% difference
Quarter
out of
to
today.
quarter to a half,
maybe a little bit in origination more. So if you were only rate and fee focused and none of these other benefits that we spoke about mean anything to you, conventional may be an okay place for you for a little while.
Yeah.
And again, it's if you're trying to stay small scale, you're not trying to scale your portfolio, you're not trying to use the Burr method, stuff like that, then sure. Conventional's your space.
What I've heard a lot of investors say is they're like, I want to go DSCR because I want to protect my credit. I want to protect what is personally attached to me.
Yeah.
And because maybe I want to buy that big, beautiful house on the hill, someday that's my forever home.
Yeah.
Well, you're not going to buy that with a DSCR loan. You're going to buy that with a conventional loan.
Yep.
So the stuff, the stuff that's personal, keep it personal, and the stuff that's business, keep it business.
That's always a rule of thumb.
Yeah.
Yeah, so this is a way to make that happen. Again, great lending solutions across the board. It's not a limitation in really any regard. It's your best fit for you.